welcome out to Tackle Trading's covered call for beginners. This is a Tackle Trading 101 series. And how about that festive music tonight? You know, it's coming into the Christmas holiday season, and we're all excited about Christmas and happy holidays and Merry Christmas to everybody out there in YouTube Tackle Trading Land. This is Coach Matt, and I am excited to be with you here this week as we navigate a journey through covered calls to the beginner level. And that's what this Tackle Trading 101 series that we do every 2 weeks, every other Monday, is all about is getting great educational content on amazing financial systems out there to the individual so that they can navigate the financial world a little bit better. And as we go through this here tonight, as you like it, give us a like there on YouTube. Give us a nice little share in YouTube as well. We love you guys at Tackle Trading, and we hope you enjoy this journey through the covered calls, through an introduction to the covered calls here tonight. We will be doing some more advanced covered call systems with our internal community at the Tackle Trading website as we get into releasing the 2022 version of the Tackle 25, which is our elite covered call system over there at Tackle Trading. As by way of introducing to Tackle Trading, for those of you who are not familiar and have found us for the first time, Tackle Trading is a educational media company that we introduce and teach people strategies and systems in the financial markets. And we have a lot of different content for different people that enjoy it in different mediums, quite frankly. And I'll get into this here in just a moment, but we have podcasts like the Huddle and the Trading Justice podcast. We have scatter reports for all of you to enjoy as you navigate the markets on a weekly basis. We do live coaches shows. We do live webinars like you're seeing here on YouTube, but we also do them in our pro member community as well. You got introductory level courses you can take through on-demand, self-paced learning. We also put out blogs, tools for traders, and our new Discord channel for our pro members. I hope you guys are really enjoying Discord, because I know I certainly enjoy Discord as well. And as always, guys, we are running specials on our educational products at Tackle Trading. So if you're looking to learn how to trade, either swing trading, covered calls, cash flow systems, you can go set up a 30-minute consultation at tackletrading.com/schedule-consultation. And with that said, let's have some fun here tonight. My name is Matt Justice, and I am going to be your host and trainer here tonight. I'm not going to do my own introduction. You guys know me full well at Tackle Trading. I'm with you all the time in the halftime reports. You can read those things if you want to, but let's get right into the show here tonight. And I'm going to basically spend an hour, ladies and gentlemen, really talking about the covered call from a what is it? Why do we do it? What do we do with the cash flow? What is the process for entry? Kind of the rules about the covered calls from the beginning of buying a stock to selling a call option to what type of call option do we want to sell? What month do we want to work in? What strike price is appropriate to sell in that as well? And as you start learning covered calls, you have to have an understanding of the options market, and specifically, because it's called covered call, specifically call options. And so we're going to spend a little bit of time tonight just discussing the basics of call options, what creates the pricing for a call option, because we need to understand the Greeks, the option Greeks that are the variables to the option pricing model, because you need to understand delta to know what strike price you want to sell, and you need to understand theta to understand why we sell in a 30-day time frame. And I'll get into that here in just 1 second. And we're going to put it all together in a covered call playbook with rules that you can take to start applying in your everyday life. The covered call, and before I get into the actual definition of it, the covered call, I think, for a lot of people over time becomes what I would define as a core strategy. And so at Tackle Trading, we define systems and strategies, core v non-core. A core system is something you do every month, every day, every week. It's part of who you are as an investor. It's part of who you are as a trader. It's like glove fits hand. That's your core systems. That is you as a trader personality. Non-core systems are things that you understand, you have some degree of efficiency in, you can take advantage of them when certain conditions are right in the market, but it isn't something you do over and over and over and over again. You do it just to simply take advantage of things you're seeing in the current market condition, such as increasing volatility, decreasing volatility. But the covered call is what I would define is not only a core system, but a foundational system, something that you can build an entire investing portfolio on, something that a single strategy that you could dial in your long-term very, very, very efficiently and fairly easily without a lot of time or money invested when you first start doing it. And I'll get into that here in a second. And I don't use that word foundational lightly because, again, core v non-core, but I use foundational because you literally can build a house upon this. You literally can build an entire portfolio based on covered calls. As a swing trader, that's really difficult because of the volatility, because of the lack of consistency in short-term price action and short-term traders. And every short-term trader knows exactly what I'm talking about. The up and down nature of being a short-term. Sometimes it's really, really, really powerful and really, really amazing. And other times, not so much. Other times, feels really, really bad when you're on the wrong side of a volatile movement in the market. But the cash flow strategies, such as covered calls, are things you build upon, and thus that's why I refer to them as a foundational strategy, a foundational system. Now, the covered call is actually fairly easy to understand when you first start learning about it, and I'm going to get into some real estate analogies here in just 1 second, because I've always found it's easy for new traders to understand real estate strategies a little bit more than stock strategies. And the simple reality is there's not really a fundamental difference in the two. It's just a different asset class. And because we grow up in real estate, it's constantly around us. It's a tangible object. It just simply is more understandable to the layman than something like a digital asset like stocks. But at the end of the day, an asset is an asset. And once you learn how to rent those assets out, you simply do it over and over and over again. And we'll get into that here in just 1 second. But the covered call is a two-step process where step one, you're going to buy a stock. You're going to buy an asset class, and you're not going to buy it in the short term. The purpose, in my opinion, of a covered call and the vital importance in step one cannot be misrepresented. And the simple reality is you are investing in a business, you're investing in a company, you're investing in that long term. The time horizon is nowhere in the immediate future. You're thinking 5, 10, 15, 20 years from now, at a minimum, a couple years or a market cycle, but you're not thinking about the short-term price action more than you're thinking about what you can do with this business, this investment from a cash flow perspective over time. And that's the key word, over time. Now, in a covered call, step one, you first got to select the stock. And then number two, you have to buy at least 100 shares of that stock, because in step two, we're going to rent that stock out by selling a call option. Now, each call option, as you'll see here in a moment, controls about 100 shares. Not about, it's very specific, controls 100 shares of stock. So we're going to buy 100 shares so that when we rent it out, we're not naked, but yet we are covered. So if the contract ever gets exercised, and we'll get into that here in a moment as well, you already have the investment to simply deliver it to the buyer at a later date. That is the structure of the covered call. Now, in this segment, we're going to focus on how real estate investors seek to create cash flow, how stock investors seek to create cash flow, and how we do that through strategies such as the covered call. So let me ask you guys a question. I know we got a very diverse group here, and I know we're going to have a lot of people watch this when we're not live in YouTube, but answer it anyways. How many of you guys understand, and guys is girls and guys, but how many of you understand what a rental agreement in the real estate market is, and how many of you have done one versus how many of you have rented? See, what I've found in traveling around this world and teaching in the amount of people that I have is even if people have never done real estate investing, they certainly understand what it means to rent from somebody else because it's all just this single transaction. You first find a property. That property could be a single family home, could be a duplex, fourplex, could be apartments, could be whatever it is, correct? We're going to find that property and typically we're going to put some money down. We're going to loan out a little bit more of the money and we're going to invest in that property, right? And that's how we make money is we simply invest in real estate and it always goes up, right? It always price appreciates. Now, I kid. That's only one way you make money in real estate, but it's not the primary way, or let me rephrase. It's not the primary reason why you invest in a real estate property. You don't necessarily invest in that property to make money simply because it goes up. And I want you to think about that because the same concept should apply to the stock market. But for most people, they come to the stock market and they treat this like a gambler's empire. They come to the stock market and they only think direction. They think a stock has to go up for them to make money. And if it doesn't go up, they can't make money. Well, that's not necessarily true, nor is it true in real estate that the only way you make money is if the price of the real estate investment actually appreciates and goes up. You got to think about that second step, right? And that second step is always renting that property out, creating short-term cash flow on the asset class, and then taking advantage of the inflationary pressures, or another word to put that, the appreciation over time. The appreciation's always thinking a little bit longer term, whereas the cash flow is always thinking about what we can do with that raw asset on a monthly basis. And I want you to think about stocks very, very similar to that, because when most people come to the stock market, they think about the two ways that you can profit in that environment as well. Step one would be buy a stock and sell it at a higher price, thus price appreciation. And that certainly works in markets that are bullish, and it certainly works over time. If you track long-term trends of the stock market, I have full confidence over the next 10 years that the market's going to be higher in 10 years from now than it is today. But in that journey we take as investors and traders between now and 10 years from now, there's a lot of downward movements in price. There's a lot of crazy volatile things that we don't even know yet exist that are going to impact short-term price action. I want to think about the buy low, sell high, not in a swing trading type mindset, but I want to think about that over time. I want to invest in Microsoft. I want to invest in Disney. I want to invest in Apple. I want to invest in XYZ company, not because of the money they're making me today, but because of the money they're going to make for me over time down the road, if that makes sense. Now, the second way most people think about making money as a stock trader or an investor is to also get paid a dividend. Now, dividend is certainly cash flow and dividend is certainly good. But I wouldn't exactly compare a dividend that a stock will pay you over a year time frame to the amount of cash flow you can generate in a real estate transaction in the short term. The dividend, in my opinion, in regards to in regards to the covered call, is more about the cherry on top that you're making money off that investment over time. But to create cash flow, see, the company doesn't pay you the dividend every month. The dividend is calculated over a year and then it's paid out every quarter. And so when it comes to the rental agreement, you're thinking monthly. When it comes to a dividend, you're certainly not. When it comes to a rental agreement, you're thinking about what you can do with that cash flow on a monthly basis, whether it's to put food on that table and or pay down some bills or pay down some debt or whatever the case is. You're thinking about the utilization of the cash flow, whereas in the dividend, you're actually thinking about compounding it back into the investment and trickling it into that investment over time. The covered call is what we consider the rental agreement in the stock market. And so when you think about rental agreements for the real estate investor, we think about covered calls to the stock investor. Once again, the rule of thumb is very simple here in America and quite frankly around the world. If you own something, you can rent it out. If you own something, you can sell something against it. If you own something, you can do whatever you want. See, that's kind of the rule here. And so the first thing we have to do is we have to own something. In real estate, it's typically a rental property of some regards. In the stock market, it is anything you want. Real estate, commodities, equity, it doesn't matter. If there's an asset, I promise you there's an instrument in the financial world to invest in that asset and to create cash flow in that asset. And so when you're thinking about the structure of a covered call, and again, we're talking Tackle Trading 101 type series here. When you think about the structure of the covered call, you always think in these two ways. Number one, as you think about step one, is to invest in a property, invest in a company, invest in an asset class. And that could be ETFs, that could be individual companies, that could be commodities, that could be currencies, that could be crypto. But you know what it can't be? You know what it fundamentally can't be in the market? If you guys remember a couple weeks ago, about 4 weeks ago now, we did a Tackle Trading 101 series on mutual funds versus ETFs with the amazing coach Greg Holmes. Well, what Greg talked to you guys about, can't do it on mutual funds, but you can do it on the ETF equivalent to a mutual fund. Reason number 475,000 why we like ETFs more than mutual funds. So when the structure of the cover call starts, it starts with buying 100 shares of an instrument. Now, for a lot of people, most people, I would say, let's not start that 100 shares with buying Google. Let's not start that 100 shares by buying Amazon. Let's not start that 100 shares by buying high volatile stocks that go up and down crazily. Let's just start something small. Typically speaking, and this is not always the case because it depends on portfolio size, but typically speaking, we deal with lower dollar stocks in covered calls. In fact, if you look at the Tackle 25, even today after the price appreciation over the last few years, you'll still find a ton of stocks in the, not so much in the $20 level anymore, but $40, $50, $60, $70 level. What you won't see in the Tackle 25 is a lot of Teslas, Googles, Amazons, for a couple reasons. Number one, they're too high priced. Simply put, they're too high priced for a lot of people to invest in 100 shares. And that's why we prefer Tackle Trading a little bit lower dollar stock, 20, 30, 40, 50, 60, 70, typically less than $100. Doesn't mean we won't do covered calls on stocks that trade above $100. It's just that for the most part, you want to work with stocks that are less than $100 because you got to buy 100 shares. Now, if you are just starting out in your career, don't fret. There's cheaper stocks even than that, but you can also just start buying 5 shares here, 10 shares there, 12 shares here, and work to get into that 100 shares. But before you write that call option, it's very important that you own at least 100 shares because once again, you don't understand. I'm talking to the very basic individual right now. You don't necessarily understand the contract yet on the call option, so you don't want to write yourself an obligation that you can't cash in later on. So you want to have at least 100 shares. Number two, once you do get that 100 shares, we're going to sell one call option against the stock we own. And I'll get into that here in just one second. Now, here are a couple rules that I want you guys to write down. At Tackle Trading, we live by trading rules, right? Now, sometimes there are a little bit of guidelines, and I will agree with that. But for the most part, we live, eat, sleep, and breathe through our trading rules. And so when it comes to the world of options, what you're going to find, ladies and gentlemen, is there's always 2 rules. And yes, there are more than that, but there are always 2 rules in almost every asset class. How much time to buy or sell, that's based on theta. How much or what strike price to work in, that's based on delta. And so for right now, I want you guys to write down a couple rules here. Okay, and you can write them down into the chat in YouTube, or you can write them down on a piece of paper. Rule number 1, theta. This is the amount of time frame I want to work. I want to work close to 30 days. Now, sometimes I'll work 45. Sometimes I'll work 15. Sometimes traders will be even crazy and do like 37. Sometimes it gets even more crazy and we'll do 22. But typically speaking, we want to work around that 30-day number, right? And I'll get into that here in just one second. Now, the strike price, there is a little bit more subjectiveness to the strike price you're going to be writing here, because the simple reality is if I am expecting price appreciation, I might not write anything in the first place. But if I've already made the decision to write the covered call, it's really going to be depending on what type of price movement I'm expecting. Do I expect a little bit of robust price growth? I might write a 0.20 delta to take advantage of that. Well, do I want to lock that risk graph down because I see an increase in volatility and I get some concern to the downside and it starts clipping support? Well, I might be a little bit more aggressive and write somewhere around a 0.45 delta or a 0.45 delta. And so it's going to be a little bit subjective, and it does certainly take some time before you can match your skill set from a technical perspective with your rule from an option perspective. But for right now, just write down 0.10 to 0.40. That is the typical range in delta, depending on the type of price appreciation or depreciation you personally expect, where you're going to be writing that covered call. So once again, keep this in mind, time and price. Now, for those of you who are very new to the world of investing and covered calls in general, I want to walk through this step-by-step process very quickly. Step one, we're going to want to invest in a company. However you find that company, maybe you found it from the Tackle 25 and you love the Tackle 25 and that's where you found it because you know the Tackle 25 is the best covered call list in the world, bar none. You know that. Now, obviously, I know that, but you get my point. Or you find it because you do the old value investing trick, the old Peter Lynch, Warren Buffett value investing, and you invest in a company you know. You invest in a company you like. You invest, you like Peter Lynch used to walk down to the strip mall and would like to see foot traffic, and that led to 26 consecutive years of beating the S&P 500, which, by the way, it was more than just foot traffic. Peter Lynch was a rock star investor with a rock star mind. But the reality is you can find a stock a lot of different ways, but that's got to be step one. Step two is once you find the stock, right? Step two, you got to write that covered call. Now we're going to sell a $23 call option. All right, so that's the structure. We're going to find a stock. We're going to invest in 100 shares. We're going to purchase it at whatever the current market price is, because we're investing long term. I don't need to micromanage the stock. I don't need to wait for an upward movement in price by 10% of the HR clipping the previous day's high for me to get in. That's not what this is. That's swing trading. That's the webinar we did 2 weeks ago. This one's a covered call. It's a little bit more simple. It's a little bit more slow. It's a little bit more long-term. And so whatever the stock's price is, fantastic. If you're comfortable with that and you're comfortable with that decision from a valuation perspective, it's ready to rock and roll at that point. The first thing I want you to think about as you're starting to wrap your mind around covered calls is, number one, we bought the stock at 20. Number two, we sold the call at 23. The first thing I want you to think about as you navigate the new world of covered calls is cost basis. Cost basis is so important to us as traders because it's the consumer that thinks about the money they're spending. It's the investor who thinks about the money it's coming back to them. Well, for us investors, for the consumer, they're going to go out there to the $20 stock and they're going to be like, oh, I just spent $20. No, you didn't. You invested $20. There's a vast difference in the two. You invested $20. And what did you create by investing in that company? Well, you were able to sell the $23 call option. You were able to generate a $1 of cash flow coming back to you. I'm doing this per share, by the way, so that'd be $100. But per share, you're generating $1 of cash flow. Well, that $1 cash flow, what does that mean? What does that mean, ladies and gentlemen? That means your cost basis is not $20. That means I spent 20, but I received 1, which means my cost basis is actually $19. Now, why this is so important, ladies and gentlemen, is because now you've just lowered your risk parameters from $20, because when you invest in a company, I don't care what the company is. I don't care if it's Apple, Amazon, Microsoft. I don't care. I don't care. Because you know what, guys? At one point in 1992, people thought Blockbuster was going to take over the world. Guess what? They didn't. They went to zero, and so did a tremendous amount of other companies that failed to evolve in the technological era. That's the simple reality. Companies do go bankrupt. And so I don't care what the banner is. I don't care how much you love that company. I don't care about any of that. What I care about is you understand when you give a company $20, you can lose $20. Does that make sense, everybody? It does not matter what the symbol is. It does not matter what the company's name is. I don't care that you love their logo. None of that has anything to do with the math behind the equation. And the math behind the equation is if you give a company $20, you can lose $20, period, end of sentence. Now, when you write that covered call out in month number 1, mind you, all of a sudden you can't lose $20 because you received $1. You can lose 19. You have lowered your downside risk because you are increasing your cash flow. Now, the question, you guys will start to understand this. The question is not about the first month, right? That's not the question. The question is how many months? And I want you to think about this because that's how traders think. They think about risk. How many months would I have to rent this company out before I've covered all my risk and I have a risk-free asset? How many months? Everybody write it down into chat. And I know there's a lag, guys. I know there's a lag. So I'm going to make some assumptions to some of my questions. I'll tell you right now, it's kind of hard being a Socratic method teacher when it comes to the world of YouTube and you deal with the 20-second lag. But we will adjust the same way everybody else does. Now, it takes 20 months. Step 3, or not step 3, but the third thing I want you to focus on is your max return, okay? Reward to risk ratio in Delta, right? Delta type systems. Reward to risk ratio is simply you got to have 2 to 1, which means if you're risking 1, you better make 2. Well, guys, ladies and gentlemen, the simple reality is you're not going to get that in cash flow systems because the max risk has to be to 0. That you have to think about it like that. So when you're talking about your max return is your cost basis to the call option you've sold. It's really that simple. So we bought the stock at 20, we wrote a call for 1, our cost basis is 19. We sold the $23 call option. What does that mean? It means somebody else has the ability to buy our stock from us at 23. Well, if it goes up to 23, guess what's going to occur? Well, somebody's going to buy it for 23. Somebody bought your call option you sold. You're going to sell that stock for 23. Now, what'd you pay for it though? Not 20, you paid 19, which means you can make a max of $4 in a month on that trade. Now, your max risk is always where, once again? Always where as an investor. I don't care what your stop loss says. Stop losses get torn apart. Get absolutely torn apart in increasing volatility conditions. So where's your max risk? Your max risk is always your cost basis, and your cost base is always whatever you purchase minus your cash flow down to 0. That equals 19. Now, when it comes to the benefits of the covered call, the benefits are immense, but they're all related to the cash flow you are receiving. Okay. Number 1 is as we just witnessed, you see a cost basis reduction. You can lower your risk and thus create more downside protection. And just over the last, guys, just think about the last 3-4 months in the marketplace from September to today. From September to today, amazingly, it doesn't feel like it sometimes, but we've actually seen a bullish market. We've also just seen 2 very high volatility downward movements in price in that same time frame. Having the ability to control the downside in this marketplace is extremely important. Because you're writing a covered call, I want you to think about stocks can only go 3 ways, right? Stocks can go up if you buy a stock, XYZ company for 20, stock goes up, you make money. Stock goes sideways, you break even. Stock goes down, you lose money. That's the consumer when they think about directional nature of a stock. Well, because you now are not the consumer, and you're certainly not just a directional trader, you're sitting in a webinar that is focusing on beginner level cash flow systems. Well, because of that, you have now written the covered call. You now are creating a cash flow environment. And guess what happens when you create cash flow? Well, you can make money not when the stock just goes up. You get to make that cash flow if the stock goes sideways. You're going to make that cash flow regardless if the stock goes up or sideways. And even on the downside, you can still be profitable because you are writing that call. That's why you are increasing your probability of creating cash flow. And once again, when you talk about heightened sense of volatility and times that are uncertain, when you're talking about that right now, guys, we're right now, and I'm not going to go into all the detail. You can come to the halftime report and sit down with us every single day, just like a lot of our community does, to break down all of the daily activity that we go through in the marketplace. But the simple reality, guys, is we're in a market environment right now that is one of the more uncertain moments that we've been faced with. When you're dealing with well, let me put it like this. When you're dealing with an environment where we're going through the increases in inflation with the uncertainty from an economic perspective, that is not an economic environment that my generation has ever witnessed in American history. My generation, the Generation X that grew up in the 80s and 90s, we were toddlers and babies when we in America went through this situation the last time. But if you want to get a sense of what the 70s felt like from an economic perspective, go ask anybody in the baby boomer generation who went through a heightened inflationary environment where an economy was stagnating, and that creates what is called stagflation. Stagflation is a nasty, nasty environment if you only know direction. But if you can create cash flow, it doesn't matter what that does. You can reduce the volatility, reduce your risk, and still create cash flow. The benefits of the covered call are truly immense when you think about it both from a macro perspective as well as what you can simply do with the cash flow on a monthly basis. Now, how many of you guys understand what compounding gains is? I know a lot of the veterans of tackle and a lot of our tackle trading community fully understands what compounding gains, but I thought it was very important to talk about another benefit of the covered call that is beyond just the reducing volatility, reducing your downside risk, creating cash flow. Compounding gains is the eighth wonder of the world, and I don't even care if Albert Einstein said that or not. I really don't care. I do believe it to be true. And so when you talk about compounding gains, I don't know a system in the marketplace that can create a more consistent cash flow stream, which means a more consistent compounding impact than covered calls. I certainly believe you can get a higher rate of return on a naked put. I certainly believe you can get a higher rate of return in a monthly basis on a credit spread. I know it to be true. You can get a higher rate of return on any directional system, but what you can't get is the consistency in those systems that you can in a system like the Tackle 25 or covered calls in general. And so I truly do believe that compounding the covered call gains is a very important part of the covered call process. And so for those of you who are new to the compounding impact, I'm certain that you understand it, but it's one thing to understand it, it's another thing to do it constantly. And that's what we're here to learn how to do, is to constantly do this on a month-over-month basis instead of what typical consumers do, is come check on it every few months and then walk away and then wonder why it's never working for them. Well, it takes time and it takes effort and it takes you setting your butt in your chair and doing it on a daily and a weekly and a monthly basis to have the impact to your life. And so when it comes to compounding gains, you first, once again, buy the stock, right? That's the whole step process. Step one, we got to invest, right? Well, we invest, which means we now have an asset class that we need to create cash flow on. We need to create cash flow on. We're going to sell that call option against it. that's going to generate some cash flow coming back into us. As we generate cash flow coming back into us, the question is what, guys? The question is what, ladies and gentlemen? What do we do with the cash flow? What do we do with the cash flow? We buy more stocks. We buy more shares, right? We buy more shares. And let's say you buy that $20 company, you sell that call option for 23, you create $100 in cash flow coming into, yeah, you can only buy 5 more shares, right? Well, you can, if you start out with 100 shares and you only can buy 5 more shares, you can still only write the 1 call option. Even though you own 105 shares, you can still only write the 1 call. But guess what you can do in 20 months from now? In 20 months from now you're writing 2 call options. And then you're writing 3 call options. And I'll get into how that works and how important that is to start that process sooner than later, because it creates what is known as velocity to money, which is a very, very, very important concept. Now, to understand, and what I wanted to do in the first part of tonight, guys, is I really just wanted to talk a little bit about the makeup of a covered call, kind of get into a little bit of the why, the structure, kind of the process. Now let's get into the call option side of the equation, because it is the call option that is most important to understand, because it's the call option we're selling. It's the call option we're managing. It's the call option that is the strike we're telling people what price they can buy our stock at. So let's dive in to the call option mechanics. Now, for those of you who are new to the market, and again, I know we have a tremendous amount of veterans here, and we also have quite a bit of new people here as you're learning a little bit about covered calls. For those of you who are, not just those of you, for everybody out there on a scale of 1 to 10, okay, 1 to 10, 1 means you know nothing about call options. 10 means you could go to Thinkorswim right now, write that 40 Delta call option with the blindfold on, not knowing the month you're working in, not knowing the strike price, and you could still click on the one you need to sell. That's a 10. Where would you guys personally categorize yourselves as understanding of call options? And I'll give you guys a second to type into chat. Now, this discussion is for the ones, because I'm certain if you are a 2 or above, you do understand what the makeup of a call option is. But when it comes to call options, ladies and gentlemen, a call option is a contract. That is all it is. Okay? That's all it is. A call option is a contract. That contract gives rights and obligations, is what it does. It gives a right, but not an obligation to the buyer, which if the buyer exercises their right, it creates an obligation for the seller. That's the structure of a call option. Same thing as a lease option in real estate, by the way. Let's say Coach Tim and I have a real estate agreement. He's got a property and I want to buy that property. Well, I could go to Coach Tim and I could say, you know what, Tim, I want to buy your property for $20. And Tim might say to me, oh, can you take out a loan for $20? And I'd be like, I don't know. But while I check on it, can we put a contract in that gives me the right to buy your property at 20 on or before this date? And I'm going to pay Tim $1 for that right to buy his property at $20. Tim's going to gladly accept that dollar because Tim wants to sell his property in the first place for $20. He's more than willing to collect $100 from me to give me a contractual right to buy his property that he wanted to sell in the first place. That is a call option. The only thing you call it in real estate is a lease option. Options are options, guys. Regardless of the asset class, a call option, a lease option, it's just called by different things, but it's the same process. A call option is simply a contract between a buyer and a seller that gives the purchaser of the option the right, but not the obligation to buy a specific stock at a set price on or before a set date. Now, there's 2 clauses in that contract that are very important, and I need you to write this down for those of you who are new to the market. If you're like my 8, 9s, and 10s out there, okay, lots of shy ones, yeah. Tim, I just saw your comment. Yeah, when the pro member community comes in, they're like, I'm a perfect 10. Blindfold me right now. I'll show you right now. Just blindfold me right now. Right. The ones are like, I don't dare swim into that pool of sharks. So I get it. I get it. But I know all these people. Okay. We were all ones once time. We were all a one at one point, guys. That one point was just so happened to be 15, 16, 17 years ago for me. Okay. That's all it was. Tim was a one at one point. I was a one at one point. Everybody's a one at one point. And then you go through education like you're doing now and you start learning more things. But I do agree. The ones are certainly a little bit shy when everybody else is like 9. No, no, no. I'm not even a 9. I'm a 10. I'm an expert. Blindfold me right now. We'll do this the right way. So I get it. I get it. That was funny though. Okay. So a call option, once again, is a contract that simply gives the buyers a right, but the sellers an obligation if the right is exercised. Now, think about you. As we're navigating this call option, guys, I don't want you to think in general about all these different buyers and sellers and all these different things in the world of options. No, 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 no. I just want you to think about you. Why you are doing what you're doing. Why, or the contract obligation that you are selling. That's all I want you to think about. Because quite frankly, that's all that's important here. Now, for the new trader in the back of your mind, you'd be like, well, I want to meet the buyer. I want to shake their hand. I want to negotiate time and price. That's real estate, guys. If you want to go shake somebody's hand and negotiate over time and price, go talk to somebody in real estate. That's not the digital financial world. This is all about you. You get to pick the time. You get to pick the price. That is the contract. The only thing you'll ever meet is yourself and the decisions you make. That's it. There's nobody else. You are. And so again, as we're going through this, don't think about the other people because you're never going to meet them. Think about why you're doing what you're doing. Think about the potential risk. Think about the probability. Think about the cash flow. Think about what you're going to do with the cash flow. Think about why you're selling that call option at that level, but you're never going to meet the other end of the transaction. So you don't have to worry about why somebody else would buy an option from you that gives them the right to buy their stock, because the simple reality is it could be an algorithm. It most likely is an algorithm, but they don't have to stay in the transaction in the same time frame you do. You are trading with what we define as Mr. Market. Okay, that's who you're trading with. And so when you sell a call option, and I used Coach Tim earlier today, so I'll use it again. If Tim sells me a call option, okay, and I buy that call option from Tim. Well, what Tim has is Tim has an obligation. He sold me the call option. He has an obligation. What I have is the buyer is a right. Okay. I have a right to buy Tim's stock at $23 in the example we used earlier. I have a right. Now, I did just say don't think about the opposite end of the transaction, but let's do understand one simple thing. Why would I buy a call option in general? Not from Tim. That's not the negotiation, but why would I buy a call option in general? I would buy a call option because I think the market's going to go up. It's honestly, guys, it's that simple. It's not more complicated than that. I simply believe the instrument's going to go up. Tim, who has an obligation to sell me the stock if it does go up past the strike price, why would he sell it? Because either one, he doesn't think it's going to go up. He's trying to reduce volatility, like we talked about earlier. He's trying to lower his downside risk, which he's trying to do, which we talked about earlier. He's trying to accomplish all the benefits to the covered call. I just think the stock's going to go up. Who's right? It doesn't matter. Tim gets to keep his cash flow. It only matters if the stock goes above that 23 strike price, because if it goes above the 23 strike price, you are going to sell your stock unless you do something about that call option. So once again, the buyer of the option has a right. If that right is exercised, the seller of the option therefore has an obligation. Now, again, the structure of the covered call is just about you, and you, or as one of my favorite movies, Me, Myself, and Irene. It's all about me, right? That type of thing. The terms of the deal are very important here, guys. Again, there's no negotiation. You get a pick. But in any negotiation over an asset class, if you've ever purchased one, you are going to negotiate two very important clauses. The first clause is the time in the contract. Okay, we were talking about a lease option earlier today, right? Well, in that lease option, you can do a lease option for a month, 3 months, 6 months, a year, 5 years, 10 years. You get to negotiate that. You get to negotiate the amount of time. Now, in that real estate transaction we were discussing earlier, the more time you negotiate, the higher the premium is. The same concept applies here. And so when it comes to the terms of the deal, the first thing we have to select is the amount of time in the contract. Now, for those of you who are new, I want you to write down time equals theta. Once again, write down time equals theta. The second thing you need to do after you have selected the amount of time in the contract is you need to pick, not negotiate, you need to pick the strike price that you're willing to sell your stock at. Isn't it cool that you get to define all this, guys? How many of you are control freaks? I'm a little bit of a control freak. Just ask any of the coaches at Tackle Trading. I'm a little bit of a control freak, not a big one, just a little bit of one. Little incy bitsy control freak. Well, guys, I don't know a market that you could have more control based on your decisions than the stock market is. You get to pick the time, you get to pick the price. There's no negotiation. You get to make that choice. And that is the terms of the deal. There is no other term here. Time equals theta, price equals delta. So the first thing, time equals theta. It is the theta rule that defines the amount of time in the covered call. It is the delta rule in our understanding of delta that selects the strike price. So once again, the negotiation in all instruments is time and price. Theta defines the time frame. Delta defines the strike price. Now, when it comes to understanding delta and theta, we need to take a quick journey through the variables to the options market. And the variables to the options market are what we affectionately label the Greeks as market participants. The Greeks are delta, theta, vega, gamma, and rho, and they represent the 5 variables to the value of an option. And so when you look at the option price, i.e. the option premium, that call option at $1 or Apple at $4 or whatever call option you're looking at, that price is created from an algorithm. It is not created based on some broker somewhere that is defining what the value is. It's not created by the central bank, the market maker. It's not created by Goldman Sachs. It's not created by any entity that you personally know in the marketplace. It's created by an algorithm. The algorithm was created in 1972 and released in 1973, and it is labeled the Black-Scholes model. It is the Black-Scholes model that defines the value of every option in the financial world. Now, these variables represent, because there's only one guarantee in the market, and that is time. In fact, one of the cliche jokes, but we'll do it, cliche joke moment. One of the cliche jokes of the market participant is, I promise you tomorrow's going to be Tuesday. And tomorrow the market's going to go up. But if I'm wrong, it's going to go down. And if I'm wrong in both up and down, it will go sideways. But I promise you it will go one of the 3. That's the old joke, right? That's direction. No trader can guarantee direction. They can simply use their analysis to give them an edge. And we call that edge probability analysis. When you look at theta, theta represents the amount of time, and specifically the amount of time that is decaying out of the premium of that option on a daily basis. Vega, oh man, volatility today, volatility yesterday, volatility the day before, up, down, up, down. Volatility doesn't mean down. It means speed of movement. And so what Vega does is it calculates the volatility of an option. And quite simply, if there's an increasing volatility condition, like we're going through right now in the marketplace, those options are priced to sell. They're premium. They have high premium, high volatility. As volatility subsides, and it certainly will, as volatility subsides, all of a sudden the value of the options go down, and therefore you like to buy them. So typical rule of thumb, increasing volatility, option traders like to sell options. Lower volatility, options are priced to buy. Option traders like to come in and buy low volatility conditions. Gamma represents velocity. And what it specifically represents is the amount of delta that will move given a $1 movement in the stock. And then rho represents interest rates, but the central bank has killed the interest rate market, and that soapbox is for another time. Now, when you look at this algorithm, and you can see it right here, okay, let's get the Epic pen, right? I want to give you guys, and you can go Google Black-Scholes model algorithm, and you can geek yourself out all you want on the theoretical option price called the Black-Scholes model, but I promise you, your mathematical skill set is far better than mine. So if you can read this algorithm, thumbs up. In fact, 2 thumbs up. 2 thumbs up to you. 2 thumbs up straight to you. You're amazing. You are quite the unique precious snowflake. I love that. But for the rest of us, I didn't win a Nobel in mathematics in 1973. Which means I don't need to understand how to build the algorithm. I just need to understand how to drive it. And the analogy I'll give to you guys out there in La La Land is this. If you go to buy a car, do you need to know how to build an engine to drive that car off the lot? Once again, how many of you drove today? I did. Not very far, but I did drive today. I went to the convenience store. And when I got in that truck, I did not build the engine for me to drive that truck. I didn't do it. You know what I did? I pushed the button, I put my foot on the metal, and I went. I pushed the pedal and we went, right? Well, guys, that's the same concept here. You do not need to understand how to build an algorithm. You do need to know how to drive it. And how you drive this algorithm called the Black-Scholes model, which won the Nobel in 1973, is you understand the Greeks and how they behave around the option premium. Delta, theta, vega, gamma, and rho. King and queen, though, and you can define which one is better for you. King and queen is delta and theta. Those are the 2 primary Greeks. And the reason I say that is because there are 2 clauses in a contract of an option. You have set price and you have set date. Well, the set price is defined by delta, and the set date in any option strategy, whether you're buying or selling, is defined by theta. As you grow in your skill set, as you grow in your experience, as you navigate our community, and you start getting into a little bit more advanced material, you'll get into volatility. Literally, if you ever come down to the halftime, come down like we're just downtown. If you ever come down, look, I'm just right down there during the halftime report, right? No, but if you ever come to the halftime report, well, guess what I talk a lot about? Volatility. In fact, volatility is dominating the conversation right now. It's very, very, very important. But it's not important to the new individual who's learning covered calls. What is important in that environment is understanding delta and theta. Delta defines the strike price. Theta defines the expiration date. And so what we need to understand here, because guys, it's one thing, let me put it like this. Before you do your first covered call in the marketplace, how much education do you need? Once again, do you need a year, 2, 7? How much time do you need to personally feel comfortable to start doing covered calls? Took me 7 years to go to law school. Didn't make a dime off it, but it did take me 7 years. I did. I got the scars too. It's called a diploma. 7 years. Took me 5 years before I started embracing covered calls, by the way. I was a short-term trader. Still love trading. Short-term trader. How much time? Because for those of you moving forward, in terms of covered calls, I don't see why it can't be this month. Honestly, I don't. Because again, this is a fairly simple system that you're learning. Number one, we're all investors. You're here. Most likely you all already have investments of some nature, whether that's in commodities or whether that's in a 401k or an IRA. You probably already have some degree of assets. So my question is not the amount of time it's going to take before you have a confidence level to start doing this. Is like, why not rip the Band-Aid off and start doing it? There's no time like now. Well, to be able to do that, you don't need to understand volatility. What you need to understand is delta and theta. And that is the point of what I'm trying to get across right now, is these others will come. But it's only life-changing if we do it. And to start doing it, you got to focus on rules. And those rules are around delta and theta. Now, every time I pull up the Epic Pen, it ruins my animation. So there we go. Okay. Now, once again, terms of the deal. Talked about this a little bit earlier. Terms of the deal are very simply this. First rule is theta. You got to select the time frame. Second rule is delta, and that's the strike price. Now, theta. Let's get to know. Let's get to know. Let's swipe right on theta here. Let's get to know theta a little bit more. Theta represents time. And quite frankly, specifically the amount of time or the amount of premium that's going to decay out of that option day after day after day after day. What that means is because theta represents a time decay, it is a negative to whoever is buying that option from you. Once again, what I want to think about tonight. I want you to think about being the covered call investor. So you're not just thinking in general terms, you're thinking about what you're doing specifically with that call option. Well, to the buyer of your call option, that theta is going to work against them. Time's going to work against them. Time, once again, think about that. Time is going to work against the buyer. Well, if time is going to work against the buyer, who's it going to work for? The option seller. And so theta is simply a mathematical figure that will represent the amount of premium that is decaying per day, thus going from the buyer to the seller. And so if you're the buyer, that literally tells you how much money you are paying every day to own that call option for. Now, once again, why would they pay that theta? Because they think it's going to go up. That's why. Bunch of gamblers in the market. Happens all the time. They think it's going to go up. Whether they're right or wrong, we don't know. That's why it is a probability. Well, to the seller, they are capturing that theta on a daily basis. That money the buyer is losing isn't going to the market maker, it isn't going to the brokerage firm, it isn't going to a third party, it's going directly to you. This is what theta does. It is a mathematical figure that tells you the exact amount of premium that is decaying out of an option day after day after day, which is a net negative to buyers of options, and thus is a net positive to those sellers of options. Now, when you look at the time decay curve, it does not decay on the exact same pace every single day throughout the life of an option. And when you talk about the life of an option, guys, you can go way far out in time. You can go all the way out, 39 months of time. You can go far out in time. And guess what? Those options aren't decaying very much because there's not a risk to time. You can also buy an option that decays this Friday. 4 more trading days. There is a lot of risk to those options because there's not a lot of time. And so when you look at theta and you're understanding that it represents a time decay, also understand that it does not represent the exact financial figure, but it simply represents what it's decaying that day. But understanding how theta creates velocity to cash flow as it gets closer to the date of expiration, and thus what represents the maximum risk to the buyer, is where that cash flow starts creating true velocity. And so when it comes to the value of an option, what this graph is supposed to help you understand is it's supposed to help you understand the amount of percentage of the value of the option that is decaying every single day. So with 4 months to go, about 120 days left in the contract, you're only going to be decaying less than 0.5%. And so I want you to think about this like we just bought an option for $100, for example. If my option is going to decay every day at 0.004 cents or 4%, that means I'm going to lose 40 cents out of my $100 every day. Now, 40 cents is a real number, but I'm not sure you're going to feel the real impact of that. And I'm willing to bet that if you guys, let me just put it like this. I went to the store today, okay? I went to the store today. Absolutely, and we love holding people's hands. It's called the tackle trading community for a reason. Now, I went to the store today, and I bought an ice cream sandwich for my wife and my daughter. This is actually yesterday. And I handed them a $20 bill. And because of inflation, I had to give them an extra $20. No, I kid. That's next year. But because I gave them like $5.75, they simply gave me like $14.25 back. Well, I took the $14 and I put that cash in hand in my pocket because it's $14. I took the 25 cents and I just put it in a little, hey, give this 25 cents to whoever needs the next 25 cents, right? We do it all the time because we don't think about how that adds up over time. It's such a minimal impact to the way we think about money that it just doesn't manifest itself. We're just done, gone, remove it from thought. We're thinking about something else. That's how small a decay it is. It's not that big of a deal to be quite frank with you. Well, as we get closer to the value of the option, what starts to happen is it starts to depreciate at a faster clip until you get to the point of that last 30 days. And this is going to be very, very important, that last 30 days, right? As it gets to that last 30 days, it starts to speed up 1.6%, 1.8%, 2%, 2.5%, 4%, 5%, until by day zero, the last day in the contract, it's decaying at 100%. And so it starts that decaying rate, right? It starts that decaying rate at about 1.6% at about the 30-day number. Now, again, these are general ballpark numbers based on the current market volatility of when I was taking this slide, which was about a year ago. It might be a little different today, but it's in the same ballpark. When you look at it at a little tighter time frame, by the way, we love our cash flow zone, that last 30 days. So good. When you take a look and you spotlight that last 30 days, though, what you can see, and this is the value of an Apple option as tracked over that 30 days. Well, with 33 days to go in the contract, the value of the option is right here about $88. Okay, and this is just theta. That's all it is, guys. Well, as day after day goes on, the volatility, not the volatility, but the velocity of that decay starts to increase at a rapid rate to where you're decaying at a higher rate and a higher rate and a higher rate and a higher rate and a higher rate until you get to the last week of the option. And the last week of the option, the value of the option goes to nothing. Okay, it goes to nothing. And so if you understand how theta works, ladies and gentlemen, and it is the decaying asset of time, if you understand how theta works in the sense that it is a friend to the option seller, it is a foe to the option buyer, that cash flow that the option buyer is losing on a daily basis, it's got to go somewhere. And where does it go? It goes to whomever sold the call option on Apple. They're cashing in on that. They're taking advantage of that day after day after day. And so when it comes to the amount of time to select in a covered call, the first thing we have to do, guys, is, ladies and gentlemen, I keep doing that, guys. Somebody told me that guys represents everything, but then I started saying dudes and they got all offended. So ladies and gentlemen and people of all shapes and sizes, I feel like I'm in the circus to a certain extent. When it comes to the step one, guys, before you get into the actual expiration date, once again, what do we first have to do? What do we first have to do? Before we sell a call option, Before we select the time frame, what is step one? In every transaction, real estate, business, equity stock, financial world, step one is to find a stock. Well, I can tell you at Tackle Trading, guys, what our community does is they like to work off what's known as the Tackle 25. The Tackle 25 is our covered call list that we put out once a year. And yes, Ann, I believe I saw a question from you earlier in the presentation about the Tackle 25. Is it a once a year? It might not have been you, Ann. It might have been somebody else. I can't remember. But the Tackle 25 is a once a year list we put out there. Now, on rare occasions, Ann, I will take a stock off the Tackle 25 and replace it with a different stock. But what I will never do is to do that just simply because of technical or volatility reasons. Remember, investors invest for the long haul, not simply because short-term volatility goes against them. If an investor gets scared because volatility increases and downside moves and the market starts moving down, they're not real investors. Okay, real investors look to offset costs, they look to reduce their risks, and they look to pick up more shares. They don't have an underlying fundamental belief in the company in the first place, is my point. That's why I said they're not investors. They're not investors in that company. They're traders who are trying to make money off the company, and that's simply a different mindset altogether when it comes to the world of trading and the world of investing. When it comes to step one, you got to find a stock that you want to invest in long term. And so I only remove companies for fundamental concerns. For example, I did it one time, CVS. I killed CVS from the list a couple of years back, replaced it. Garmin. Actually, Garmin replaced CVS. CVS had one of the worst earnings reports I've ever seen. I got very concerned about the underlying fundamental nature of the company, and I removed it from the list. Okay. Outside of that, we don't update unless the stock deserves to get kicked off in the first place. If a stock goes down technically, write covered calls and write more of them. And if you don't know how to do that, get into the Tackle 25, and the Tackle 25 will teach you that. So the first thing we got to do is we got to select a stock. Now, the example I am going to use here tonight is MGM. MGM is a stock on the current edition of the Tackle 25. And as you can see, here's the current list. You can see a lot of stocks in the 20, 30, 40, 60, 70. We really do try to keep this stock. And again, there's no set rule on the price. But again, the higher the price you go, the more investment capital you have to have, which means the higher the portfolio is, or the higher the capital in the portfolio needs to be. And so there's no set rule that if you go to a certain price threshold, you can't do covered calls. It's just a matter of you have to own 100 shares. And so when you're looking at the Tackle 25 here, I'm going to pick MGM here. Number one, because I was thinking Camping World or CSIQ or Bank of America. They're all really good covered calls. But yeah, MGM kind of stood out to me today, and I really, really like it from a cover call perspective. And so there was a subjective reason of why I chose MGM. It just kind of stood out to me today. And so the first thing we have to do here on MGM, guys, we got to buy 100 shares. Okay, and we can buy 200 shares, we can buy 500 shares, 1,000 shares, but we have to own 100 shares. Now, once we own the 100 shares, we're going to write covered calls. Now, based on what we just learned in the theta rule, is the first thing I have to select is the amount of time frame in the contract, right? The amount of time frame in the contract. And I know you guys, I know you guys have questions, and if nobody's getting to your questions right now on YouTube, I apologize for that. What I will do is I will open it up to some Q&A at the end of tonight, guys, and I will spend some time answering your questions here tonight. And again, I know you have some questions, but because there's a lag on YouTube versus what I'm saying, it is near impossible for me to answer the question in the same time frame as the topic we're talking about. And I do deeply apologize for that, because again, that's not my preferred educational method. It is one-on-one and live in person and all that jazz. But I promise you, I will spend some time at the end of the presentation answering any of your questions, because I think this is like I said originally, This is a foundational system. It is a foundational strategy, and it's something that you could build upon for a very, very long time. And I truly do want you to understand the mechanics so that you could start doing this in your everyday life as well. And so MGM here, that's step one. We got to find a stock. We found the stock off the Tackle 25. We're going to buy 100 shares. That's the example we're going to use here tonight. We're going to buy 100 shares. So we're going to go to the market. We're going to buy 100 shares of MGM. Now, guys, ladies and gentlemen, what you will see is that we're just going to use an example here tonight of buying 1-to-1. What that means is I'm going to put up 100% of the cost of the stock. If it's $42.21 per share, I'm going to pay $42.21 per share. Now, a lot of the times, though, investors will use what's called margin, which means they will only have to put up half the cost of the stock, which means instead of putting up $42 a share, they would only have to put up 21. But for right now, we're just going to use 1-to-1 to make things very simple. And by the way, I do not believe new investors should use margin. I think they should, if they're going to cut their teeth on an investment, do it with your own money. You'll protect it a little bit better. Now, we're going to look at MGM here. Okay. First thing we have to select is the amount of time frame in the contract. Now, what did the rule say? What did the rules say? How much time should we sell here? Closest to 30 days. Now, for a lot of veterans of tackle trading, they'll typically work on weeklies here. But for those of you who are new to the market, you probably want to sidestep the weekly options for now. And the reason I say that, ladies and gentlemen, is simply because they are a little bit less liquid than what is considered monthly options. The monthly options are the one labeled in white. Weeklies, as you can see, are labeled here in yellow. Now, just to quickly understand that, if you'll see, I have the volume and open interest right here. And if you'll look down these columns, look at the amount of options that are being traded on this option throughout the lifetime of this contract. This is the amount of contracts that were traded today. This contract has simply not been in the market very long to have the liquidity, which means we got a little bit wider bid-ask spread, a little bit more difficult to get in, a little bit more difficult to get out. Trade management's going to be a little bit more difficult as well. And so you kind of want to navigate around that when it comes to you being first in the marketplace, learning how to do covered calls. And so when you come out to the monthlies, as you can see, that contract right there is 14,607. The bid-ask spread is about 8 cents. You see how that bid-ask spread is tighter. You see the amount of contracts have been traded on that. You had 888 today. That's because why? Well, this contract's been in the market for a lot longer, i.e. monthlies go out to 39 months from now, and thus you have more liquidity on them. And so you really want to work in the monthlies when you're very new to covered calls. As a veteran, you can certainly navigate the risk and the liquidity concerns in weekly options a little bit better. You know how that's done. But again, speaking to the beginner level, you would probably want to work in the monthlies. And when in doubt, stay out a little bit more time. If you ever get to the equation of, well, is it 15 days or 45? They're right there next to 30. Again, new traders revert to more time, not less time. You can, because again, shorter time, you have gamma concerns, and there's other sharks in those waters you don't yet understand when it comes to the last week of options. And so for right now, again, revert to a little bit more time, then less time. And that's why we are going to the 46-day contract. So when we come to the 46-day contract, there's a reason I selected 46, okay? I want to take advantage of theta. I want to take advantage of that last 30 days of the decaying asset. I went away from the weeklies because they're a little bit less liquid. The monthlies allow us to get in and out. The bid-ask spread is a little bit more tight there as well. And so that's the reason why we chose the 46-day contract instead of the 32-day contract. And I just wanted to go through that. Now, as I go through Delta here, then we're going to get into the Delta rule, and we're going to go back to Thinkorswim here in just 1 second. Now, the first rule was to help us select the amount of time in the contract. The second rule is to help us select what price we want to control that instrument at. And that's what we like to talk about when it comes to delta. Delta is a very important Greek, and I would put it up there with theta, quite frankly. Delta represents precision. It represents probability. But what it actually represents is two things. It represents something to the buyer of an option, and it represents something to the seller of an option. To the buyer, what it represents is the amount percentage-wise that you're going to capture per a $1 movement in a stock. Once again, to the buyer of an option, what delta represents is the percentage of a $1 movement that they're going to capture. So if the delta says 28, you get to capture 28 cents on the dollar. If the delta says 66, you're going to capture 66 cents on the dollar. If the delta says 99, you're going to capture 99% of that money. If the delta says 1.01, like 1, you're going to capture 1% of that $1 movement. That's what delta represents to the buyer. To the seller, it doesn't represent anything from a percentage capturing perspective, because that's not what you're doing. What it represents is probability. What delta defines from a probability perspective is the exact percentage that option will finish either in the money, and thus the option will be exercised, meaning you will sell your stock, or 2, the percentage that it will finish out of the money, which means you will not sell your stock. Because nobody's going to exercise their right to buy your stock at 23 when they could go to the market and buy it for 20. But if it goes above 23, that's when they'll do it. That's why if you sell a 23 delta or a 23 strike with a delta of 0.20, the market is defining your probability of 20% that you would have to deliver your stock to somebody else. That means you have an 80% probability of simply cash flowing. So once again, to the buyer, it represents the amount of money you're going to make or lose given a $1 movement in the stock, as represented by a percentage. To the seller, it represents the exact probability of that strike price finishing in or out of the money. Now, when it comes to delta, there's a lot of strike prices, as you saw when we went in and we were looking at MGM, we were looking at all these different strike prices, and there was just a lot of them, right? Well, how we cut through a lot of that noise is we look at our delta rule. Now, to the buyers of options, typically speaking, and you can write this down, typically buyers will work in the money, ITM, in the money. It means there's actual intrinsic value in that option. You can learn a little bit more of that in Options 101 over there at Tackle Trading for the Pro members. To the seller, sellers want to sell a delta that will range between 0.10 and 0.40, but generally put, we want to sell options that are what are known as out of the money. And if you don't understand what in the money versus out of the money means, it simply means, can the contract be exercised? Once again, if you buy a stock at 10 and you sell a $12 call option, nobody's going to exercise the right to buy your stock at 12 when they could go to the market and buy it for 10. Therefore, that call option would be considered out of the money. But if the stock goes up to 13, well, somebody theoretically could exercise their right to buy your stock at 12 when the current market is at 13. That, therefore, is called in the money. And so if the contract could be exercised, that is typically in the money. When a contract would never be exercised, that is what we deal with out of the money. Now, in general, not all the time, but in general, buyers like to work at or in the money so that they have real value to the option. Sellers, on the other hand, want to work out of the money, and thus because there's only known as extrinsic value, otherwise represented by EV. Extrinsic value, let me put it like this. There's only one guarantee in the world of investing. tomorrow will happen. That's it. Tomorrow will happen. That is the only guarantee in the entire marketplace, is that tomorrow will in fact happen. And when it comes to EV represents the exact financial figure of decay based on that time. In fact, extrinsic value is a guarantee to go to zero. That's why traders and investors, when they sell options, like to sell out of the money, because 100% of the value of that option is made up of extrinsic value, which is guaranteed to go to zero. So if they hold that contract to expiration, the value of that contract is zero based on time decay. Well, to the buyer, that is, once again, as you just understood theta, that is negative. To the seller, that is positive. And so if you understand EV versus IV, buyers like to work in the money, typically with the delta above 0.50. Sellers like to work outside the money, OTM, out of the money, and they typically will initiate a contract depending on the type of system or whatever their subjective thought process is. Because once again, if I expect direction, I might sell a more conservative delta. Well, that will range typically between 0.10. If you expect a massive growth, you'll probably want to work a little bit deeper out of the money, 0.10 delta, versus if you expect some degree of neutrality, somewhere around a 0.3 to 0.40 delta. And there are even times, ladies and gentlemen, when the market is going down and traders want to aggressively offset loss, is they might even write a 0.50 delta because of what happens to the delta as the stock price does in fact go down. So once again, let's go back to the world of Thinkorswim. We selected MGM here based on it being a Tackle 25 stock, and that's got to be the first step. Step two is we're going to initiate a contract. That contract, we're going to work based on theta. We went to closest to 30 days. The 46-day contract here was selected because, number one, we're in a basic tackle trading 101 program, teaching the world of covered calls to new traders. And for those new traders, there are certain landmines that they got to learn to navigate. And one of those landmines is quite frankly, liquidity. The amount of open interest, the amount of volume that's into a contract on a monthly basis versus a weekly basis or at weekly options is going to be vastly different, because the amount of time that the monthly contract has been traded and open to the market versus the amount of time these weekly options have. And I hope that kind of helps you understand the why, right? The why. I oftentimes do this. I oftentimes say, don't ask why. And then I spend 45 minutes detailing the reason of why you actually do stuff, because I think it is important, guys. I think it is important for you to understand the mindset of why we do certain things, why we go out a little bit more time, why we sell a little bit less time. Those decisions can be subjective in nature. Now, that's where we kind of got up to. Now we got to determine which one of these strike prices do we want to sell. You see all these ones, 1, 90, 89, 84, 49, 44, 49, 34, you name it. Look at all those different strike prices. Well, first and foremost, I know a couple things. I got rules. That's what I got. I got rules. And by the way, one of my rules said, pull up your Epic Pen. So I searched Epic Pen in my Google, and it pulled up Spice Girls, Tim. I haven't looked up Spice Girls in literally 48 years. That's interesting. Okay, now, when you're looking at this here, guys, we're not working there. Not at all. That's not what we're working. Those are in the money. We want to work out the money, right? We want to work out of the money. And so it's not there. We want to focus really kind of where these strike prices are right here. Okay. There's my 0.39. Remember the range, 0.10 to 0.40, right? Remember that range, 0.10 to 0.40. Now, we sell a 0.40 when we want to do what? When we want to lock down that risk graph a little bit, right? We want to lock down that risk graph. We expect some neutrality, maybe a downward movement in price. We want to be a little bit aggressive in that environment. So when we write a 0.40 delta again, we are absolutely expecting neutrality or downward movement in price. If we expect that stock to go up, guys, should we ever write a 0.40 delta? Ever once. Not unless we know how to aggressively manage that. That's done when we expect neutrality, maybe a slightly fading price action, even a downward movement in price. If I expect a rapid upward movement in price, we might leave this uncovered and not write the covered call that month or this week. We might allow it a little bit of room to breathe. But a lot of times we are going to write that somewhere between 0.4 and 0.10. That means we're writing anywhere from the 45 strike all the way down to the 50 strike. Now, if I write the 50 strike, I can bring in myself $65 of cash flow, and that's fantastic. If I write the 45 strike, I can bring in a whopping $178 in cash flow. That's quite a bit more than 65, right? But there's things that go with that. If I write the 45, well, I might get the stock called from me because the stock price is only at 42. It's not that big of a distance. And the market defines it at 39% probability anyways. So the market is defining my probability of my stock getting taken from me. Well, you know what I love to do? I love to come here and I love to use my technical skill set to help me determine exactly where to sell that. Because at Tackle Trading, we certainly do believe in zone defense, but we love being precise. We love selling an option with precision. And so for me, in the covered call, I love to identify a known resistance level. And I love to sell an option slightly above that known resistance level so that if it does break out, I know I already have my decision made whether or not what I want to do with that call option. And I know that's a little bit more advanced than what we're getting into here tonight. But once again, there is a subjective decision you have to make in what strike price you want to sell here. If I expect upward movement in price, I want to open up that risk graph a little bit, be more conservative with the strike price I'm selling. If I expect neutrality, I could be a little bit more aggressive with the amount of cash flow I want to bring in. For me here on MGM, it's really simple. I love the support level at 40 and I love the resistance level at 45. Those are the key technical levels that I'm personally tracking on MGM. Well, if my analysis is basically neutral between 40 and 45, and I come back to the option market, do I want to sell a contract with a 0.39 delta at 45? Once again, you guys are helping me make this decision. If we're neutral between 40 and 45 and I've identified resistance at 45 and I want to sell above resistance, that means I don't sell the 45 call option, even though it fits within my rules. I'm going to go out a little bit more and I'm going to sell slightly above that 45 because I want that 45 to work for me. And here's why I love this rule, guys. The number one decision you have as a covered call investor is not when to get in. It's not what stock to buy. It's not what strike price or option or expiration date to work in. It isn't. The number one most difficult decision you will ever have as a covered call investor is when to leave it uncovered. Go ask anybody with experience in trading covered calls and specifically the Tackle 25 system. It's never on the downside. The downside of covered call management is very simple. It's all about the efficiency of money and it's all about net liquidation. And it's very easy to understand as you start navigating a little bit more advanced content. But the number one decision you will have to make in a world that markets go up over time is what to do with the strike price if it gets breached. Because nobody's going to buy your stock at 46, which is the strike price we're going to sell in this example, with the current stock at 42. They're not going to do it at 43, 44, 45. But if this stock goes above 46, we are selling somebody the ability to buy our stock at 46. And I promise you, if it stays above 46, it will absolutely happen. And it does not have to wait for expiration. And so if it goes above 45 and starts getting into 46, what did it first have to break out of for me to get threatened here? What did it first have to do for my 46 strike price to be in danger of being exercised, and thus me delivering my stock at 46, which is, by the way, not a bad thing. It's max return on the covered call. What did it have to do? It had to do Coach Frank's favorite directional trading system out there, and that's called the breakout. It had to break out of this neutrality condition, which means the management decision I have is really, really simple. Let that puppy appreciate, wait, it gets in, let it get into 50, work its way into 50. When it gets to 50, write the 55 call option. It makes life simple. If you put in the time that is necessary before you ever make the transaction, your management will be simpler. If you take a little bit of time to go through all forms of analysis, to make sure that your technical conditions are where they need to be, it truly will make management that much easier. Because the reality is this: if I sold that 45 call option, ladies and gentlemen, it's a wonderful call option to sell. You can bring in some really good cash flow, but you're going to have more decisions to make at 45 because it's resistance than 46 because it's above resistance. And I hope that makes sense, guys. And again, I just want to kind of get into the mindset of why we would sell that 40. And again, I'm talking about the 40 delta versus a 30 delta versus a 10 delta. And so I just wanted to open up the floodgates a little bit, open up Pandora's box just a tiny bit to understand the mentality and the decision we're making regarding the strike price we're selling, because it's certainly not as simple as just sell 30 days and sell a 0.40 delta. It is a little bit more complicated than that. And so we used our rules, theta and delta, and what we're going to do is we're going to sell the $46 call option, and that has a premium of $150. Okay, $150. Now, when I did this example earlier today, I did it right after the market closed. I think I was getting like 143. The bid-ask spreads open up at night. They'll tighten back in. So we're going to use the numbers as I got them earlier tonight. And so once again, we're going to go to the market. We found MGM. We're going to buy the stock for $42.21. We're going to simultaneously sell a 46-day contract because we selected 46 because we needed to go out to more time for liquidity reasons. We then came to the market, and out of all these strike prices, we didn't talk about 99% of them. We didn't. We talked about 2, 45 versus 46. And the reason is technically I identified 45 as a resistance zone that fit the parameters of our option rules, somewhere between a delta of 0.10 if you expect price appreciation, 0.40 if you need to lock down that risk graph. We went above resistance because we want the market to work for us, not against us. We went above resistance and we sold that $34 call, 34 delta, $46 call option. We're going to bring in $150 in cash flow to us. Does everybody understand the structure? And do you appreciate, guys, that I go into a little bit of a detail and get into a little bit of the mindset of the why we select the strike prices we do, why we select the time frame we do it in as well? I hope you guys do. I hope that does help you understand the decision-making process. And so coming back to MGM, step one, we bought the stock for $42.21. That's the current stock price. And again, we're making an investment into a company long-term. We're going to pay current market price. That's $42.21. Step two, we sold the $46 call option. And no, we weren't bringing it. It's $150 now, but earlier today it was $123. Okay, volatility overnight, markets open up the bid-ask spreads. We sold the call option for $1.23, $123 per contract. Now, once again, you guys, we went through this when we were doing the case study of XYZ buying it at 20, selling that $23 call option, right? Well, in this example, here's the math behind it. Our cost basis is $42.21, but that's not our real cost basis. Our real cost basis is $40.98 because we know how to do covered calls and not just consumer 101 buy stuff. Number two, because we are writing the covered call, we're increasing our downward protection, which is very important in every market, but especially right now. We increase our downside protection by $1.23 per month because that's the amount of cash flow we're going to be bringing in. And you know what, guys? Sometimes it might be at $100, and sometimes it might be $1.50. It just depends on the volatility at the time, and obviously the price of the stock at the time as well. The max return on this example, live case study, this example, we sold the $46 call option. Somebody has the right to buy my stock at 46. Okay, that's fantastic for them. I'm never going to shake their hands. I'm never going to meet them. I could care less about them. All I care about is me, myself, and Irene. When it comes to the world of options, you cannot get into the mindset of negotiation. We all want to shake somebody's hand and negotiate time and price. Until you have to do it, you would rather just pick. That's what we get to do as traders. We get to just pick. Downside protection by writing that covered call, bring in a little cash flow. Our max return is always the strike price we sold. In this example is 46 minus our cost basis, right? It's not the purchase price. Purchase price is minus cost basis. And so we actually have to minus the 40.98, which equals over $5 in terms of max risk. Now, because we're investors and traders and we understand stocks can go up and stocks can go down, our max risk in covered calls, and we have to accept this, guys, is the stock can go to zero. It has to be, that has to be the acceptance of an investor. If you don't think that's real, there's a lot of historical case studies that we like to call horror stories that would scare the dickens out of you. And if you need to get scared based on investor stories, oh, Coach Tim, podcast subject coming up. Let's scare the dickens out of people so that they can control position sizing, right? Control position sizing, but you got to accept it, guys. That's the reality, because there are case studies like Enron. And by the way, it's not just Enron. Apple, the company you know and love today. Well, guess what, guys? After the 2000 market crash, it was $1 a share. $1 a share. Once again, $1 a share. The IBD top 50, a widely followed list. The ID top 50. It's the Investor Business Daily top 50. It's a good list. Really good list, by the way. Really good list. Takes into account technicals, fundamentals, volatility. Really good list. Guess what? In the 2008 subprime market crisis, 5 of the top 50 went bankrupt. Gone. Bye. Out of here. Gone. Sayonara. Never existed again. Investors' money went away. Gone. Guess what? The average downward movement of price in an IBD top 50 stock was 68% that year during the subprime market crisis. You got to accept those things, because if you don't think they can happen to you, I promise you they can. You have to accept max risk. Now, do I think MGM is going bankrupt next month? Tim, do you think MGM is going bankrupt next month? I don't think that. But again, I'm not talking about what's happening in the next month. I'm talking about the mindset that you have to accept as a trader and an investor is max risk, and max risk is always zero. Always. By the way, it's the same conversation you have to have as a real estate investor, as a business owner, anything not named consumer. That's the acceptance of that reality is max risk always lives at zero. So if you buy a stock for 20, max risk is zero. You buy a stock for 100, max risk is zero. Now, what is our max risk here? 40.98. Now, I got a job to do here. My job is to get that to zero as fast as possible. And I'm not talking the stock price. I'm talking the max risk potential, which means our job is to write that covered call month after month after month. And whether or not we know it or not, we accept it or not, that time will pass. And in about 37 months, about 3 years from now, people who took advantage of this webinar and didn't just sit here for 1 hour and learned how to do a covered call for 1 hour, but wrote covered calls for the next 3 years based on these parameters, And again, volatility changes. Before I see the YouTube comments, volatility changes. Yes, I accept that. Price changes. Yes, I accept that. Strike price change. Yes, I accept that. I accept all of it. But it doesn't change the fact that the amount of time between now and zero will pass. And the more covered calls I can write between now and that time, the more risk I can control, the more risk I can offset. The world of investor is not about the money you make. We believe that money will be there at the end of the day. The world of an investor is about the money you're controlling, the money you're protecting, the money you're hedging. Everything as a trader is about controlling risk. Everything is. Everything as a trader is about controlling risk. The covered call is a fantastic system that allows you to protect risk, compound gains, and there's not a better, more conservative way to create cash flow, in my opinion, than the covered call is. Now, here's this example on MGM. We purchased 100 shares. We bought MGM. And again, we're not on margin here. We're just paying 1-to-1. 42.21 was the cost per share. We're paying 42.21. When you get a little bit more advanced and a little bit more education, then you'll be introduced to margin. But you shouldn't touch margin. And I want to say this, and I want to be very, very clear on something. You should not touch margin if you have any doubt, any concern in any capacity. Not in this world. Not in this environment. You should treat margin with hot stove, put the gloves on, and be conservative. And then until you can master a system, you shouldn't use that system with other people's money until you have proven it out for yourself. And I know you didn't come here to hear that disclaimer, but honestly, I also don't care because I'm going to say it anyways. Because it needs to be said and it needs to be heard. The max risk can be zero. And I'm not trying to scare you guys. Covered calls are beautiful. Ask anybody in our community, ask any pro member here and ask them how much they love covered calls, and they'll tell you the same thing I will. It's a foundational strategy. It's something you can build a house upon. It's something that can fundamentally change your life and create wealth for your generations. But you got to accept the risk. You got to accept the responsibility of that. Now, in any system, stocks can go up, down, or sideways. If the stock goes up past 46, in this example, on the one we just did on MGM, you're going to sell the stock at 46. You bought it for 42.21. You're going to make $379 in the stock. You to keep the cash flow received upon the execution of the option. You're going to make a total of $502 or 11.89%. And despite the market, and that's per month, by the way, that's if stock goes up. And I'm willing to bet, despite the market going up 16% this year, your 401k hasn't done that. And that is per month. That's if the stock goes up. Well, what's the odds of that happening, guys? I mean, what are the odds of a stock going from $42.21 to $46? Man, those got to be pretty good odds, right? Got to be pretty good odds. I don't know. I'm not a mathematician. I didn't create the Black-Scholes model. All I know is we sold the 34 Delta contract. So the market is defining that as 34% probability. So 34% of the time at expiration, because it defines it at expiration, 36% of the time, or 34% of the time, it will go up. And if I do nothing, which you'll learn how to do something, but if I do nothing, that can be taken away from me. I get to make the $502. Pretty good little system so far. Now, if the stock goes sideways, and guess what MGM's done for a very long time here, guys, outside of a couple moments. Look at that sideways neutrality. Look at that sideways neutrality. See, investors are like, oh, go up. Right? How many of you are sick of yelling at the next high flyer? Well, you don't have to do that in covered calls. I don't hear anybody that knows about covered calls yelling at a stock, go up, go up. No, typically they're like, don't go up that high. It's a different mentality. It just is. But look at this neutrality. I have a lot of confidence in that continuing. And thus, I have confidence in our ability to cash flow 2.9% or $123 per 100 shares every single month, because the value of that option is simply going to decay. Nobody's going to exercise it because nobody would. Why would you gladly go pay 46 when you go do the same thing at 42? Nobody would. And so if it stays neutral like it has done outside of one moment in time over the course of the last 10 months, time goes on, tick tock, we create our cash flow, 2.9% monthly. Now, if the stock goes down, what happens? Well, if the stock goes down, ladies and gentlemen, that's not necessarily a bad thing. In fact, as a veteran covered call individual, I can tell you I kind of like it when my stocks go down in covered calls, because it makes my management really, really easy. It makes my management really, really easy. And you know what else it makes easier? What else does it make easier, guys? I know tackle trading knows this. See, we don't care about much at tackle trading. We just care about cash flow. Compound. See, if my stock goes down, it means the velocity of the market has killed the value of my option, which means I don't even have to wait 45 days to actually buy it back. I can buy it back in a couple of weeks at a very, very lower price. And as the stock price goes down, that means I can actually buy more shares with the amount of cash flow that I just created. We have to rethink we have to think about this a little bit differently. Again, the people that beg stocks to go up is typically because they're trying to get rich quick. If you're at tackle trading, I hope you've shed that mentality. That mentality is a garbage mentality that does not work. All it does, get rich quick mentality only gets people poor. That's all it does. You take on too much risk in too short of a time frame. It never works out, and you always give it back. Go ask the casino why they keep feeding people drinks at 2 a.m. after a winning streak. Just keep them there playing. They'll give it back. Just keep them there playing. You want to keep it? Create it slow. Get rich slow. Get rich through cash flow. Get rid of that mentality of things have to go up, because they don't. They only have to go up in your mind, in your world. That's not this world. And what I've always said to people is this: if you are new to the market, the number one thing you need to do right now is open your mind, because anything you think you've been taught about the market isn't right. And I promise you, it wasn't taught to you by educators or traders. Open your mind to these potential, to the new possibility and how traders navigate the market, not how consumers navigate the market. The last thing we do here, guys, ladies and gentlemen, is we compound the gains. That's the last thing we do. Whether the stock went up, whether the stock went down, whether the stock went sideways, we have one last step to go, and that is to compound the gains. Because when it comes to compounding gains, it's the eighth wonder of the world for a reason, but it wasn't built that way in a day. It takes time. We started this example with 100 shares. 100 shares. This is my compounding gains calculator. By the way, there's a very, very good and popular one over there at Tackle Trading. If you go to Google and you type in Tackle Trading compounding calculator, it'll pull it up. But very, very good one. But this one illustrates kind of a little bit more detail that I want to do. Stock price, we were purchasing at 42.21. We're not going to calculate the dividend, and we're going to receive $123 in cash flow. So once again, let's go through this again. How many shares are we starting with? 100. What is the stock price? 42.21. What is the premium per the contract? And that's $123. Okay. Now, what this compounding gains calculator does, and it's just an Excel spreadsheet, but one that I absolutely love, is it will take the amount of cash flow we're creating, the $123 in cash flow, and it buys the amount of shares we can with 123. So if the current stock price is 42, we can buy on average, as you can see, sometimes 2, sometimes 3, and sometimes 4 shares a month. Okay, you can kind of see it over here. Now, as we create that cash flow, what we do every month is we buy a little bit more shares. And again, guys, $123 a month, we can buy other things with it too, right? It's your cash flow. We're not doing this. We're doing this in an account we can utilize. So what can all of you guys think about you can spend $123 on? What could you spend $123 on? Take the wife out for a nice dinner date? Yeah. Couldn't take the kids. Gonna leave them home. Go to the movie. Bring them popcorn, right? Warren Buffett still pays for exact change when he goes to a McDonald's. Does that make me cheap when I tell the wife to bring the big bag to the movie theater? Wait a sec. Did I say the quiet part out loud, Tim? C'est la vie, right? Yeah. $123 can't really buy a lot of life-changing things. We can have a singular moment in time, but again, we have a lot of those singular moments in time. What else it can buy is more shares of the stock. And that's what you really should wrap your mind around, is to reinvest, compound those gains, and buy more shares of the stock. Because eventually, what you're going to get is you're going to get 200 shares. And that's going to take you 3 years in cash flow. 3% average ROI, 36 months will take you about 3 years to create a 100% rate of return on the cash flow so that you now have 200 shares. Now, as you get to 200 shares, what now can you do? You can write out more contracts, right? You can write out more contracts, 2 contracts. We're not getting $123 a month at that point. Now we're getting $246. What that means is it's going to take 18 months to get to 300 shares. It took 3 years to get to 200 shares. It'll take us another 18 months to get 100 shares. Do you see how the velocity starts? The velocity starts. And the more time you do this, the quicker you level up from 400 shares to 500 shares to 600 shares to 700 shares, because it creates velocity to money. A lot of times people never accomplish what they want to accomplish in life financially because they never give themselves enough time to get there. They create a long journey and they try to get there in too short of time frame. They simply take upon too much risk. Well, here's what I believe. You can take a lot of risk in the market to get to where you want to go if you have a foundation of cash flow. That is the mindset around cash flow systems. Now, let me show you what you can do as you get a little bit more education. Number one, we're still going to start with $100 a share, $100 per share or total shares, but now we're going to do it on margin. And instead of paying $42 per, we're going to do it on 50% margin. By doing it on 50% margin, ladies and gentlemen, guess what that means? It takes half the amount of time. Instead of 3 years, it takes us 18 months to get to that next one. And you know what you're also going to do? You know what you're also going to do? Because I know you guys, I know you want to speed up that journey, and I'm good with it. I'm good with it as long as it's done conservatively. I'm good with it. You know what else you're going to do? You're going to take out of your own pocket $100 a month and you're going to buy 5 shares. And again, this could be any $40 stock. I'm just using MGM. That's it. I'm just using MGM because it's one I was looking at today. It's one on the Tackle 25. I know the fundamentals like the back of my hand. I'm comfortable with it. You got to make those choices though. I make the choices for me. You make the choices for you. And so in terms of this, one thing that I feel is good habit, especially as you're just starting out, is to park a little bit of your earned income, a little bit of your salary, a little bit of the things that you work very, very hard for, and take 100 of those dollars and save it in your favorite stock, whatever it is. In this example, we're calling that MGM. And what $100 allows me to do is it allows me to buy 5 more shares of a $21 company because we're doing this on margin. The first example I gave you guys was basically non-margin. This example I'm giving you is margin. So once again, we start with the 100 shares. We take the $123 of cash flow and we buy about 5 more shares a month with it. We then take 100 of our own personal hard-earned dollars and we buy 5 more shares with it. Think about it like a savings account. Now, what that compounding impact does is it creates what is known as velocity to money. And as that velocity to money goes, whereas it took 3 years to get to 200 shares, now it takes 1 year to get to 200 shares. It takes 1 year to double your cash flow rate, 1 year. And $246 a month after 1 year in one stock is not life-changing money. It's not. If you ever use it to buy anything other than compounding these gains. Because the very second you use that money, it has zero value to you. The very second you take that money out of the market and you go buy that pair of sneakers with it because you can't wait on it, that money is worthless to you. It has zero value to you and never will again. So keep it compounding. Keep it building. Get it working. And as you see, you create velocity. After 2 years, you start creating about $492 in cash flow. And as you can see, it starts compounding. The velocity gets faster and faster and faster and faster until I think you get to a point where most people would genuinely accept it to be life-changing money. And it all started with a simple fundamental understanding of what $123 truly does represent. And ladies and gentlemen, that is my presentation on covered calls. And I hope tonight that you have learned a tremendous about covered calls, the general makeup of a covered call in the step 1 versus step 2, the rules around the covered call in terms of the what strike price to write and what expiration date to write them in. A little bit of the management, but a heck of a lot of the mindset. And I hope you have truly enjoyed this webinar on covered calls. And I hope you take it and you start making it starts making an impact in your everyday life. So what have we learned here tonight? Number 1, what is a covered call? Number 2, what is that theta rule? Because we got to select the expiration date first. Well, we're going to sell about 30-day numbers. Delta rule. We're going to focus in the 0.10 to 0.40 delta range. And you know what? I would love just to tell you 0.40. And when I was a younger investor and I was an educator, I would tell people, hey, before you get to there, just get into 0.40. I don't think that's good enough, quite frankly. I really don't. I don't think that's good enough, especially for tackle trading. We want to understand pinpoint accuracy. We want to be market assassins. I want to know exactly where I'm going to sell and why I'm going to sell it at that point. In the MGM example, we sold it at 46 because it was within our delta rules, but it got that strike price above a very key technical level that I was personally identifying. And I simply wanted resistance to work for us and not against us in that example. And then the last thing is, what do investors do? And investors compound the gains. Ladies and gentlemen, that is Coach Matt, Tackle Trading 101 on covered calls here tonight. A beginner's guide to the covered call. I thoroughly enjoyed this, guys. I thoroughly enjoyed this, and I will be answering questions that you guys have on covered calls. If you have any, I know there's been communicating within the chat. My focus really has been there. I've been trying to do that routine, but I can't really catch the questions quite efficiently. So if you have any questions about anything we provide our community, either in YouTube, freemium products, or beyond, you can certainly email us at team@tackletrading.com, and you can go and schedule a financial consultation to identify your educational needs as you start to navigate the world of investing. You may have some educational needs, I would say. And so the only thing I would really want to discuss here tonight is really just those stages in the leveling up process that we like to categorize at tackle trading. Stage 1 is freemium. That's what we're doing here tonight, guys. And in our freemium products that we put out there on YouTube and some of our other freemium products like the 7-step guide to trading or the different podcasts, we like to put quality information in everything we do out there, ladies and gentlemen. So check out our YouTube program, check out the Trading Justice podcast, check out the 7-step guide to trading, a wonderful introductory product that will teach you kind of the step-by-step approach we like to do in the market on a daily basis. The option Greek guide, I introduced Delta and Theta to you guys here tonight. We actually have a 2-hour, this is what we do at Tackle, guys. We do awesome stuff. We actually have a 2-hour freemium product that we call the Option Greek Guides that will teach you everything you need to know about the option Greeks. You also have many, many blogs we put out there every day, Tackle Today, Women in Trading as well. The pro membership is really what you want to focus on, guys. That's the Learn, Trade, and Connect. Those are all of our courses. In terms of our 101 series, this is the Tackle 100. In our 101s in the pro member community, they basically pick up where we leave off here. You also get access to shows, traders lounges, cash flow clubs, premium blogs, and a lot of other goodies that we put in our pro member community on a daily, weekly, and monthly basis, including different masterminds for every system we have, as well as the exclusive Discord channel. When you're ready for education, we also have premium systems that will teach you different trading strategies. We have trading labs, which are specific to coaches, and we also have an amazing one-on-one coaching program as well. Those things, guys, if you have interest in that, we are running a holiday special as we do every single year. You can sign up for a consultation at tackletrading.com/schedule-consultation. You can schedule that at any time, and you can sit down with Coach Emily or Coach Tim for a 30-minute consultation to really identify what your educational needs are. And as always, you can just go to the Tackle Trading store and you can pick and choose whatever you want. You guys know me, I love social proof here. So if you love Tackle Trading, let us know in the YouTube chat right now, because Tackle Traders, people are going to be watching this 3 years from now and you're not here. If you love Tackle, let them know. But I like to give you guys a little bit of testimonials as well. We capture our testimonials third party from Trustpilot. Angelo says these guys are the best. They really care about their students and are dedicated to promoting financial education and economic freedom to people everywhere. That is true. 100%. Literally around the world. Around the world. It is fantastic. Number 2, the resources and coaches are excellent and help traders of all levels and experiences succeed. Here we're doing a Tackle Trading 101 for beginners. Oh, just wait till we rip that Band-Aid off though, right? It takes some time. But in the back of the lifeblood of Tackle Trading, guys, is we're educators. We love to teach. We love to teach. Love, 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 love to teach. My son will just tell you I love to hear my own voice. That's not true. I literally do love to teach, and I just can't. I hate when I leave something where I feel like it could be misrepresented. Like I want people to understand how to navigate, not just be told. Tackle Trading is great community. Thank you for that. Thank you for that, Bill. Lots of information to help on the path of active trading. I agree with that as well. Ladies and gentlemen, that's been Tackle Trading 101, a beginner's guide to the covered call. I had an absolutely fantastic time, and Coach Tim needs to realize, I think he does understand it, an hour is not good enough for me. I like to actually be thorough. So we went 2 hours again. I hope you guys enjoyed it here tonight. And if you have any questions for me, you can hit me up over there in Discord, Tackle Trading. Hit me up in Discord in the Tackle 25 covered call thread in Discord. Let me know what you thought of tonight. Outside of that, if you guys have any questions, I know Tim. I see, Tim, you've been answering a few of those questions. Let me scroll up a little bit. Oh, smooth. Smooth. Coach Matt, this is quite possibly my favorite training session ever. Hey, thanks, bro. I appreciate that, Smooth. I really do. That warms my heart. Thank you. Coach Matt, awesome content presentation. Listen, if you need to say compliments to Matt, that's fine too. I'll take the compliments too. You guys are great. Love you guys. Awesome. The food was enjoyed tonight. You guys are amazing. All right, guys. If you do have questions, I promise you, and if I did miss some, I promise you my team will comb through some of the questions in our YouTube channel over the next couple of days to answer them there as well. But as always, ladies and gentlemen, you can answer any question or you can ask any question in our Tackle Trading Discord channel. There literally is a thread on covered calls called the Tackle 25. We just started that thread. So definitely ask me, definitely ask any coach over there, any question you have on any system, but that's where you would direct that one for covered calls is the Tackle 25 in our Discord channel. Awesome. Awesome. You guys are amazing. Love you guys. Hope you enjoyed the webinar here tonight. I am going to go eat dinner and say hello to my amazing family. You guys are great. I'll see you tomorrow on the Halftime Report.